We are looking at Lululemon this evening, this afternoon, or this morning, depending on where you are in the world. Because I think this company has a huge amount of upside right now. Bruce says it's fallen out of favor, and I could not put it better myself. Let's take a look at Lululemon stock price. So it's currently $305 a share. Let's look over the past 5 years. Past 5 years up 48%, so it's just underperformed the market over the past 5 years. Down 21% this year. However, that doesn't tell the whole story because that's after about a 40% recovery from the lows we saw in August. Now, I actually sent an email out around this time. I think it was just after this, talking about, I think this stock is a great value proposition now. And even at this price, I think it's a great value proposition as well. So let's talk through it. Let's talk through the numbers first and foremost. As of today, it's a $37.5 billion company. They do roughly $8 billion a year in revenue. They are profitable. It's a very, very profitable enterprise, actually, in terms of the margins. Trades at 23 times trailing earnings and 21 times forward earnings. And that's even after the 40% run up in the past couple of months. So I think it would help here to first understand the narrative that pushed the stock so low in the first place. So let's go actually to Lulu stock, and I want to get a bit granular on this. So we peak really at the end of last year, and then we fall almost, or just over half actually, 53% from the end of December to the beginning of August this year. Does anyone know why? Does anyone know why it happened? Robert said the pandemic. What specifically regarding the pandemic? A man said competition. Who would the competition be in this sense? A man, because we could go multiple ways with the competition angle. So a man says the retail stores. So do you mean competition in just the retail sportswear? Okay. Bruce said it's a status symbol and fallen out of favor. I think that definitely has something to do with it. And the bigger picture is this stock was priced as a growth stock for a long time. The way we can look at this, if we go to the financials and we go to the ratios historically, if we look at the historical earnings ratio, so this has been a profitable company for a while. And it's only sort of in 2018 when the growth story really starts ramping up. We're not going to look at the market cap growth. We're not going to look at the stock price, but we're going to look at the PE ratio. We go from 32 to 30 to 40 to 40 to 48 to 73 to 42 to 46. And at the beginning of the year, it was 40. So it's a premium price stock, and you only get premium pricing if you have high levels of revenue growth. And you see here, we go from 13 to 24 to 20, slow down a bit, 42, 30, and then you see the slowdown here, 18 and 13 in the latest quarter. So we go from 30 and 40% annual revenue growth down into the teens. If your top line isn't growing at 20% per year, the growth company narrative doesn't work. So what happens? Your multiple gets bid down, and then you see your stock price falls off a cliff. Like I said, 53% peak to trough here. So now the question is, if this isn't a growth company anymore, what is it? And here's where my thesis comes into play. I want to look at the numbers here first and foremost. So this is 10-year growth rate annually. Remember, CAGR is annual growth rate. Revenue, 22%. We've already ticked that off. Okay, but what about gross profit? 22%. Earnings, 24%. Free cash flow, 28%. What's this telling us right now? If earnings and free cash flow are growing faster than top line, David says it's good, but how is it good, David? A man says they're managing expenses well. Yep, that's absolutely true. It all comes down to one thing, which is efficiency. And there's one statistic above all that sort of highlights this. And this is a very, very key thing when we're looking for companies that can transition out of that like growth at any cost phase and then move into the next stage, which is, can they consistently compound earnings? So profitability. What can we see here? If we look at these factors, what is the trend in the margins? Every single one, as the chat says, is improving. Every single one is increasing. So straight away, we can say two things. Number one, very efficient company. Derivative of that, very well managed company. So we have improving margins. Then we also have something else. What else do we notice on here that's really, really good? Especially from an investor standpoint. A man's got it. It's this one here. Share buybacks. All baby, all baby. This is what I love to see. So this is not, this is not an Apple, this is not an AutoZone where we're seeing huge numbers of buybacks. The company isn't at that level yet. But we are seeing consistent buybacks every single year. So even when the company was at the peak of its growth, they were still doing buybacks on a net basis. And now the buybacks are actually really ramping up. So in the past year, 2.8% of the float has been repurchased. And that actually leads to a higher buyback yield because of the lower stock prices. And a man, you are correct. That is one of the reasons for higher earnings per share. So now we are in a really, really good position because we get this scenario where the stock can expand in multiple ways because we have a relatively muted valuation. It's trading at 21 times forward earnings. Historically, it's traded at about 40 times forward earnings. So there is room for the valuation to grow. but earnings is also growing. So we get that really powerful 1-2 punch of earnings growth plus multiple expansion. So I don't know if it's, I don't think it's visible. I think my Coca-Cola share certificate is covering it. In the book, The Davis Dynasty, we talk about Shelby Davis, probably the greatest investor that no one's ever heard of. This was one of his favorite setups for a company. A relatively muted valuation plus the ability to grow earnings. So you have the earnings per share increase combined with the valuation multiple expansion. That gives you outperformance when it comes to a stock price. Give me a 3 in the chat if this is making sense so far. Very cool. Very cool indeed. See a lot of 3s in the chat. Now, let's get into the qualitative side of this. How are they actually going to grow earnings? So, even though I say this is not a growth company anymore, what I mean is it's not a growth at all costs company. There is still growth to be had. So I'm in the 10K here, which is also serving as an annual report. So Lululemon, if you don't know what they do, they are a higher end sportswear, athletic wear manufacturer. Give me a 2 in the chat if you own any Lululemon products. I don't necessarily know if my audience here is the target audience. Oh, a man, me and you. Me and you, we're like that. When you're a classy guy, I knew you would. And at the risk of sharing too much information on these calls, they make the best underwear for men that money can buy. Guarantee that. I own 12 pairs myself. Chip, excellent question. I will circle back to that at the end because Chip's asking about if they've committed to buy back shares or is it just dependent on earnings. So there's a couple of misconceptions about this company. First of all, biggest misconception is that it's only a woman's brand. And that comes from the truth is always a trailing effect of narrative. Because this started primarily as a women's brand. It's got a very interesting history, Lululemon. The original founder, a gentleman named Chip Wilson, was a bit of a strange guy, a bit of an odd guy. He was very upfront in saying he wanted to make clothes that made women's behinds look good. So there's a couple of problems with that statement, and he was actually removed from the company because he couldn't really get away from that as the vision. There were some questions about his ethics and his morals, and he was removed from the company quite a few years ago now. So this is not a founder-led company anymore. So originally it was a women's sportswear, athletic wear brand, primarily focused on yoga pants and sort of that holistic sports lifestyle clothing. No longer is it purely a women's brand. 23% of revenue is now men's. They also have a growing sort of accessories and other products line. So you see combined here, this represents 87% of revenue, and they have other product categories. So that could be things like accessories. One of the things that was very, very popular was like a sling bag, a smaller sling bag for women. Very, very popular on social media over the past year. I have a men's version of it, not a Lululemon one, but one that it's actually very practical, especially when you have a child. So shout out to little sling bags you wear over your shoulder because they fit nappies in and they fit a bottle in. Diapers from my American friends. they also have multiple geographical growth engines. So in 2021, this was very much a North America only operation. It is becoming less and less dependent on North America. So in 2023, North America was 79% of revenue versus 85% of revenue in 2021. Company forecasts that outside the US will account for 1/3 of revenue by 2026. So we have geographical diversity. So even though top line revenue is growing in the low teens, that's North America growth. China is growing at 65% a year. Rest of the world is growing at 38% a year. So the minority geographic regions are growing faster than the overall company. That's a good sign because it means the growth in those regions is still intact. So that's factor number one in why I believe the earnings will continue to grow. Factor number two is this company definitely has a secret sauce. Bruce says China's hurting economically. I disagree when it comes to the news that we've had in the past month. The big stimulus, I think, has put an extra shot in the arm. I think before a month ago, I would have 100% agreed with you. And by the way, I'm still very bearish on Chinese companies. But I am now much more bullish on the Chinese consumer, especially when it comes to what we would consider luxury or status hungry brands, of which Lululemon is one. Now, a couple of months ago, we covered Hermes, which I would argue is probably the number one status coveting brand in the world. I think Lululemon, Lululemon is not in the Hermes tier, but it is probably the most coveted sportswear brand in the world. You could argue that in the US, other brands are stronger or more coveted, and that Lululemon has fallen out of favor a little bit, but I think worldwide it is still there. If we look at things like Net Promoter Score, if we look at things like average website visits, there is a lot to be said for what they've actually been able to design. And the other part of this that I think is overlooked is Lululemon owns their distribution mechanism. So they're not like Nike, where they are very reliant on third parties for distribution. You're not going to find Lululemon in Foot Locker, for example. You're not going to find Lululemon in Sears. No, Sears has gone out of business. What is it? Macy's, that's the one. Wait, did Macy's go out of business as well? Which department store is still standing? Someone tell me. JCPenney went out of business. Sears went out of business. Is Macy's still there? I'm sure it is. Is it? But you're not going to find Lululemon there no matter what. So they have roughly 60% of their revenue through e-commerce. So their own website. And the other 40% is through company-owned stores. So they have a physical footprint as well, but also a very strong e-commerce footprint. Thank you, Brenda. Macy's is still here, so is Dillard's. I've only been in a Dillard's once, and I thought they hadn't cleaned the carpet for 30 years. That's neither here nor there. Is Ross a department store? I thought Ross was just a clothing store. I thought it was just their own brand stuff. Don't think I've ever been in a Ross. Once again, neither here nor there. So, Lululemon owns their distribution mechanism. Part of the big plus for owning your distribution mechanism is guess who sets the prices? Lululemon. There's no pressure from retailers saying, "Hey, you gotta cut your prices." There's no retailers taking the product, slashing 30% off. Once again, Lululemon, they get to control their pricing. Therefore, you could argue that they have pricing power. I'm not going to put this as like a pure pricing power company, but if you can charge above average prices for your clothing, for your goods, then I would argue you do have a degree of pricing power. What kind of pricing power? If you're not familiar with Lululemon, let's look at, no, I'm not going to look at yoga pants. Let's look at men's hoodies, a much more safe choice. So most purchased this week is a pullover hoodie for 128 US dollars. That's quite expensive. I've never paid $128 for a hoodie. I don't think I've paid more than 30, but that's neither here nor there. So the fact is, if the most purchased product is a $128 hoodie, they're doing something right. Probably explains why they're selling at 58% gross margins. Remember what I talked about before. Physical product company, anything above 40% gross margins is good. 58% is phenomenal. Let's look at Nike, for example. Nike's gross margin is 44%. Let's look at Under Armour. Under Armour's gross margins, 46%. Is Aritzia public? I don't think it is. We looked at Hermes before, and their gross margins were in the 70s, I think. Yeah, Hermes, 71%. So Hermes is the cream of the crop. The other company that does this really well is Crocs. Theirs are, well, 58%. So basically the exact same as Lululemon. But 58% gross margin's phenomenal. ATZ is the ticker symbol for Aritzia. Let me check. Oh, it's in Canada. 40%. So Aritzia is okay. I didn't even know Aritzia was Canadian. Thank you, man. Okay, there's something I want everyone to notice here. Can we see this? Can we notice something that's going on here? What is happening on this website? No one's got it. Straight away. We've got collaborations. We've got Olympic gold medal gymnast. We've got the NHL, which is that ice hockey thing. So we're getting audiences from outside of, things like organic search. They got membership as well. This is key. Early access, events, free adjustments. Tell you, as someone who's 5'6", we appreciate those. Everything's too bloody long in the leg. But you see this here. This all ties in to something. What are they selling here? What is being sold here? All of these center around one. It's bloody popcorn. Bruce says happiness. What specifically are they selling though? What is being sold? Everything here fits into one category. Yes, health and fitness. Here we go. Aura Ring, fitness tracker, Barry's, workouts, Erewhon, I believe is the health-focused grocery chain, which is bloody expensive. Gyms, skincare. No idea what this is, but it's probably smoothies. They're selling a lifestyle. This is the customer base. And this is what is the key behind this whole thesis. Health and fitness in the past 15 years has blown up as an industry. And I know what people are thinking. What? What do you mean? What do you mean? Like, there's always been gyms. People have always worked out. No, 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 no. No, no, no. 15 years ago, people did not walk around in sportswear as an everyday thing. People didn't wear sportswear brands to the office. The percentage of women that went to gyms 15 years ago compared to now, night and day. And that's just in North America. And I would argue Western Europe as well. In countries like China, not even close to reaching peak penetration. I would argue, in terms of societal trends, especially when it comes to health and fitness, countries like China, India, Vietnam, these countries with the increasing purchasing power, they are where the US was in 2014, 2015. So it started, but it's nowhere near reach maximum penetration. So the growth engine is still there. So there's a few things going on right now. You've got societal trends, you've got pricing power, you've got customer loyalty, and all of those things can lead to increased earnings over time consistently. Now, Chip asked earlier, with these share buybacks, is this a deliberate thing or is this a discretionary thing whenever they've had extra cash on the books? It's a deliberate thing. So they are authorized to buy another $1 billion. It's actually 1.2 billion over the next year, which roughly represents about 3% of the market cap. So 3% as a share buyback amount is what we consider like pretty aggressive, but not excessive. Apple at their peak, I think, did 7% in a year. But a 3% buyback yield is what we would expect from a stock that's notorious for buybacks. For example, if we look at AutoZone, which is probably the #1 buyback stock in the universe, they consistently buy back 5, 6, 7% of the float each year. Apple has actually slowed down their buybacks a lot. So you see here, they're at like the 3% level the past few years. They had that time where they were going absolutely insane, 5%, 5%, 4.5%, 4.8, 7, 5.7. But now Apple are back to the threes again. So 3% a year as like a buyback target is sustainable, but not excessive. Because a company like this, you don't want them to spend all of their money on buybacks, because then it's like, okay, where's the R&D? Where's the growth going to come from? But a commitment to buybacks with a portion of the cash is exactly what I would want to see as a shareholder. Because, you know, as much as we've gone through that phase for the past decade where every company pretends to be a tech company, these guys are not a tech company. It's not to say they haven't made mistakes, because they've made some awful mistakes in the past 5 years. They purchased a platform called Mirror in 2020, I believe, for $500 million. Awful acquisition. That's one of these things. So they call it Lululemon Studio now. They're not even advertising the Mirror anymore. Where's the Mirror gone? They may have stopped selling it. So it's one of these things. It's a mirror you have in your house that has apps on it. So it was for like at-home yoga classes, things like that. They paid $500 million for this company. It made no real sense. And yeah, within 3 years, they decided to stop selling it. So yeah, it's not like they are immune to making mistakes, but I think this is a much better use of their capital. Now, what can go wrong here? We should always think about that. What can go wrong? Should we go to the risk factors section? China tariffs? Yep, absolutely. How much of their products are made in China, though? We'd have to actually look at that. One of the big question marks for me is this. We've talked about this before with especially clothing companies. While they can have patents and IP protection out of the wazoo, clothing is one of the hardest industries to actually achieve any degree of protection against both counterfeits, but also what we would call duplicates. Where, let's say, for example, there's a hoodie that is a duplicate of a Lululemon one. The material is slightly different, but the design is identical. The other company we looked at where this was a real problem was Birkenstock. So same thing. While the material may be slightly different, the design can be identical. We see a lot of this with Lululemon. So the real question is, does this become something that materially impacts their business? Or is this something that's just like a bit of a minor inconvenience, but ultimately it's something they can live with? So that's one of the things I've written down here. Patent protection and design IP is weak in the clothing space, and low price duplicates and knockoffs can affect the bottom line. I would say the biggest one is, excuse me, I would say the biggest one is probably the first point here. The athleisure trend is not as strong as we believe it to be. It doesn't take off as much in emerging markets. or sorry, should I say, and or Lululemon does not have the pricing power or brand image and status that we believe them to have. You know, right now across the world, we're projecting a 9.5% growth rate through 2034, which is enough to sustain a tailwind. I know technically I always say 10% CAGR, but I'll round it up. I'll be nice, I'll be generous to myself. Because, yeah, there's lots of competitors out there. But there's not that many that operate in this specific space. I would say the closest one is probably these guys. Alo Yoga. So once again, this is very expensive stuff, but really you're selling a lifestyle. You know, I can get, oh, men, they do men's now. I can get I don't want, yeah, you see, this is expensive stuff, but they're selling a lifestyle. This is probably their closest competitor. These guys aren't public, by the way. I believe they were bought by I don't know if a private equity firm bought them or just took a stake in them for somewhere around the $2 or $3 billion valuation. But apart from that, okay, here we go. Here we go. We got some numbers. We do not manufacture our products or raw materials and rely on suppliers located predominantly in, well, China mainland being the big one. Vietnam, Cambodia, Sri Lanka, Indonesia, Bangladesh. Fabrics, Taiwan, a bit of China for the fabric. That in itself is a question. But I don't think this is a tariff loser, so to speak, in that sense, like some other brands would be. How are we feeling about this one so far? Give me some thoughts in the chat. Hello to Anastasia. Hello to Ian as well. Ian, I apologize for the time zone issue. David doesn't know. David's in two minds. Please show the valuation sheet. There we go. There we go. All right, let's do the valuation then. This is a profitable company, so I've used the mature sheet. So Lululemon. We've got current PE ratio 23. Forward PE of 21. Earnings per share growth, I've got 14% here, which is actually pretty conservative. See, David says, I think a downturn in the economy can hit them hard. I think it's one of those things that it doesn't affect companies as much. Like Lululemon. It affects the middle. It affects the Nikes of the world. A man is saying, is a 14% earnings growth conservative? I think when they've achieved 24% over the past 10 years, yes, it is. I don't think 14% a year going forward is out of the question at all. Because you may say, oh, but that's also what you forecasted for Hermes. And I was like, well, Hermes is almost 10 times bigger as a company. A man says, but growth is slowing down. Revenue growth may be slowing down. But revenue growth, even though it's slowing down, was 13% last year. Earnings growth was higher. Because once again, increased efficiency, share buybacks, because buybacks play into this. Got to remember, when we're talking earnings per share growth, buybacks play into this. So if we use those numbers, based on these two, based on the very conservative valuations, once again, it's traded much higher than this. The average PE over the past 5 years has been 49. But once again, we've got to be conservative here. So using the current PE today, the fair value I've got is 288 per share. I've got 270, 287 there. Bruce says, why don't you use the most realistic number? That is the most realistic number. That's based on the current earnings multiple. Unless you're asking me, why don't I use one more aligned to what the company is historically trading at? If I did that, it would be assuming that the multiple increases. I don't want to assume that. Because whenever we're taking entry to a stock, I want to be conservative. So I think the best number to use right now is the current multiple. And if I use the current multiple, 288 per share is the number I come up with as a fair price. So it's 305 today. So this is roughly 5% below what it's trading at. A man says, any chance of a multiple contraction? Yeah, absolutely. I mean, it traded as low as 15 times earnings in August. But once again, a company that's displayed this level of resilience, this level of earnings growth, because remember, this is a time when every company goes through, where we transition out of the high revenue growth at all cost stage and into the earnings growth stage. And every single company gets hit with this. So at 15, if you want to do that, let's say the PE was 15, then you get 183 per share as the fair value. Don't know if you're ever going to get a chance to buy this at 183 per share anytime soon. You might do, I might be wrong. But even at the absolute low, it traded at 226. So you got a couple of choices here. 305, you can wait and see, or you can use options. If you're going to use options on this, here's the way I would play it. So you've got earnings December the 5th currently. You've got a November 29th expiry. I would be looking at selling puts at, I'd go 290. So at 290, you're getting just over 2% for a 31-day trade. Your cost basis, if you do get assigned, is going to be 283 and 40 cents. So below what I think is the fair value. If you don't get assigned, it's a 2% trade, not bad whatsoever. Robert says, at present, it's constantly going up. Guess what? Stocks go up and sometimes they go down as well. David says, you need a 30K account. Hey, you need a 28K account. Yeah, absolutely. The current trend is it's going up. Let's go to a trading view. I'd absolutely sell puts on this tomorrow. And man, I know what you mean. I generally am not a big fan of retail stocks. The only ones I like are the ones that are very, very expensive, like Hermes. We could also do a call one day on like something like Richemont Group, which is like Hermes but for watches. Another large company trading at about the same multiple. But yeah, give me a 6 in the chat if you enjoyed this.